A college dropout walks into a room with a napkin sketch. 3 months later, a stranger hands him $10 million. Here's why that actually makes sense. Most people think venture capital is just rich people gambling on ideas, but it's not random. It's a system built on a very specific problem. Startups need money before they make money, and banks won't touch them because they have no collateral, no revenue, no track record. A bank needs to know you'll pay them back. A venture capitalist bets that you'll become so valuable that their small stake today becomes enormous tomorrow. Let's say you and a friend want to start a software company. You have an idea and some coding skills, but building it costs money, servers, salaries, marketing. Neither of you has $100,000 lying around. A bank says no. Your parents say get a job. That's where venture capital enters. A VC firm looks at your idea, your team, the market you're targeting, and asks, could this be worth $1 billion in 5 years? If they think yes, they write you a check, maybe $5 million. In exchange, they take a percentage of your company, say 20%. They don't own your company outright. You still run it, but they own a piece of the future value. This is called equity. It's not a loan. You don't owe them money back. You owe them growth. Why would a VC accept that deal? Because of the numbers. Let's say 10 startups get funded. 8 fail completely. The VC loses their money on those. One becomes moderately successful and returns 3 times the investment, but one becomes huge. A $5 million stake becomes $500 million. That one win pays for all the losses and then some. It's a portfolio strategy, like a gardener planting dozens of seeds knowing most won't sprout. So the VC isn't being generous. They're making a calculated bet. And the startup founder isn't getting free money either. They're trading ownership for runway. They're saying, I'll give up a chunk of future profits so I can build this thing today instead of waiting 5 years to save up. But there's a catch. VCs don't just hand over cash and disappear. They typically take a board seat. That means they get a say in how the company operates, hiring decisions, product direction, strategy. They're not passive investors. They're active owners who want to steer the ship toward the biggest possible outcome. This is why venture capital shaped the tech industry the way it did. Companies that take VC money are under pressure to grow fast and big. Slow, steady, profitable growth doesn't excite a VC. They want hockey stick curves, flat for years, then vertical. This incentive structure has created some world-changing companies. It's also created a lot of expensive failures. Here's another layer. Startups often need multiple rounds of funding. You get $5 million in round 1, called Series A. You burn through it in 2 years. Now you need more to reach profitability. You go back to VCs or new ones for Series B, maybe $20 million. Your original investor stake gets diluted. If you succeed, the pie grows so much that even a smaller slice is worth more. If you fail, that slice becomes worthless. And here's what most people don't understand. Venture capital is a Western, mostly American phenomenon. It exists because of specific legal structures, tax incentives, and a culture that celebrates risk-taking and tolerates failure. Other countries have tried to copy it. Some have succeeded. But the system only works when investors believe that enormous returns are possible and that those returns will actually reach them. So when you see a headline about a startup getting $50 million in funding, you're not seeing charity or a gift. You're seeing a bet. A group of investors is betting that the founder's idea will become so valuable that a $50 million stake today will be worth billions tomorrow. Sometimes they're right. Often they're wrong. But the system only keeps running because enough of them are right often enough. That's why venture capital exists. It solves the mismatch between when money is needed and when profit is earned. It's not magic. It's not luck. It's a mechanism. A way to transfer resources from people with capital to people with ideas in exchange for a piece of the potential upside. Understand how it works, and you understand why some startups explode while others vanish. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're curious about how other financial systems actually work, not what to do with them, but how they function underneath, subscribe. There's a new explanation every week. Subscribe so you don't miss the next explanation of how the financial system actually works. This video is for educational and informational purposes only and is not financial advice. Always do your own research.